I need your help. I want you guys to go in the comment section of this video and tell me where you think the overall stock market is right now amongst this chart. I personally think we're somewhere in the panic or the capitulation phase, but I want to get your opinion in the comment section because that'll help me analyze where most of retail investors right now are sitting at. And in turn, that could help us all as investors understand where the consensus estimate of the market is when it comes to fear or greed. But obviously that'll just be the retail perspective, and in this video I want to address the opposite side of the coin and address the institutional perspective of this bear market and the recent crash in stocks to see why the Fed is yet again making one of the biggest policy mistakes they've ever had and how we could be setting up for a face ripper bear market rally. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to address this screenshot that I recently came across on Twitter where Neil Kashkari from the Fed was warning us in September of 2020 that runaway inflation is just a ghost story and that inflation is indeed transitory and that COVID-19 was simply causing some noise in that data. Now, it's absolutely hilarious to see in hindsight how poorly aged that comment was, because obviously in Feb of 2021 is when inflation spiked to almost 4%, which caused a lot of fears around interest rates. And I think what that screenshot really shows is that none of the Fed officials know what they're doing when it comes to tackling inflation that was induced by a pandemic. Jerome Powell was literally calling inflation transitory in 2020 and even in early parts of 2021. And now here we are with one of the fastest interest rate hikes we have ever seen, and with a Fed that is aggressive in putting the US economy into a recession, even after the CPI inflation data has already showed signs of peaking. And the fact of the matter is that if you look at any of the leading data, we already saw so many signs over the past 1 month that inflation has already peaked, as clearly seen by the 5-year break-even inflation rate, which is down significantly from its peak of 3.6 in March of 2022. And with oil prices down over 30% from their peak and home prices also cooling down and falling for the first time since 2012, there is no doubt in my mind that inflation has either peaked or is very close to peaking, which means that the Fed might need to ease off the throttle pedal when it comes to increasing interest rates, because otherwise they will end up throwing us into a recession that we might not have even needed. As a matter of fact, one of the most experienced investors in the stock market, Jeremy Siegel, has recently said that Powell is making a big mistake because he's hiking way too fast, way too much. What the Fed should have really done is taken action sooner on inflation in 2020 and 2021 and not try to cram interest rate hikes into a 6-month span trying to overly act ahead of the midterm elections. And this aggressive rate hike is already being put into action as clearly seen by the value of the dollar, which has skyrocketed for a 12-month span, something we have never seen in the past 20 years. What this has done is skyrocketed the amount of people that have been rushing into American bonds because of their higher yields. And what this is creating is a potential oversupply situation where within the next 2 years, we could start seeing deflationary trends in the bond market and prices start to skyrocket on the 2-year and the 10-year. And no, I'm not talking about the yields, I'm talking about the actual bond prices, which again are at one of their most oversold conditions we have seen in the past 41 years. And I think what many people don't realize is that when you have so many people rush out and cash out of both bonds and equities at the same time, there is a record amount of cash which is now sitting on the sidelines, which is obviously getting devalued with inflation and the printing of money. And with the dollar so strong, it's actually going to become detrimental for US businesses to work with external companies because obviously they're no longer going to be able to afford to purchase in USD. And at some point, that cash will need to be deployed into the market as investors all of a sudden seek return as inflation is peaking. And with now only 2% of NASDAQ 100 stocks sitting above their 50-day moving average, there is a big opportunity for investors to grab some good companies at cheap discounts. Over the past 2 decades, every single time we have reached this kind of area, it's always been a good opportunity to buy, except for obviously some of the more capitulation-driven events like 2008, where we saw a global financial crisis, the exact opposite situation of what we're experiencing today. Because keep in mind, in 2008, we actually had deflation and companies miss estimates and reduce earnings by 90+%, which is not what we're seeing today, as seen in the first and the second quarter earnings reports. And as for the folks that are comparing 2008 and 2000 to the current market crash and expecting the market to go even lower, I have one word of caution for you. Do you really think when we have high inflation that tech stocks and the overall companies that prop up the S&P 500 are going to be performing poorly? Because last I remember, both 2000 and 2008 were deflationary times, not inflationary times. And those were all driven by massive bubbles in very concentrated sectors like real estate and the dot-com companies. Whereas right now, we're seeing a broad sell-off in basically every single tech company. This includes healthcare, IT, automation, and even obviously EVs. And as you can see, by the time that the official recession is announced, which is what many people are waiting for before buying stocks, the market is already in the middle of its collapse and near the bottom. So for me at least, this pullback we are seeing in the stock market over the past 1 year is simply a cool down in the very high inflationary period we saw throughout 2020 and 2021, where supply and demand got imbalanced. I think people tend to forget the fact that inflation shows that the economy is actually doing really well. All the Fed is trying to do is actually reduce the rate of growth in the economy artificially, because otherwise inflation is going to wreck the middle and the poor class. And that's exactly why this rate hike drama is basically a politically driven event. After all the criticism the Fed has received over the past 2 years for calling inflation transitory, these guys are on a track to try to prove the market wrong and be really aggressive and trying to meet the overall consensus opinion. And obviously that opinion is that inflation is really high and that we need to go into a recession and that the Fed needs to do exactly that to be a successful Fed administration, which would obviously help them gain more votes in the midterms. And unfortunately, I think that is a mistake, and I completely agree with Jeremy Siegel when he mentions that the Fed is still looking at lagging data to judge inflation, not leading data. And as for what this means for your stocks and my stocks, well, nothing much, but a better buying opportunity if we see any sort of declines in their prices. Now sure, some people might call me stupid because the market has continued to go down, but again, if anybody was able to predict exactly where the stock market would go in the short term, they would probably be geniuses and they would be multi-billionaires. But obviously, the stock market is designed to dupe most investors, and the people that really make it out on the long term are the ones that are patient, stick to a consistent strategy, and focus on the long term, not the short term. And as you can see right now, based on the SPX McClellan oscillator, which is one of the most trusted indicators in the market, we are near this oversold territory when it comes to the breadth of the entire S&P 500, which means that generally speaking, you are getting a good deal if you're buying near this area. This doesn't mean we are near the bottom or this is the bottom, because absolutely no one knows. All I can say is you're getting a good opportunity to dollar cost average into your favorite companies if your conviction still stands. And it isn't just individual companies. Even if you're looking at the overall index, you should be buying this if you're looking to retire within the next couple of decades, because this kind of collapse of 20+% is something we rarely see happen in the stock market. And as you can see, despite what happened in the dot-com bubble and 2008, the market always recovers and continues to go up, even though in the short term during those bear markets, it feels like the end of the world and that the market will never bottom. And as for which stocks I am buying the dip on from an individual standpoint, essentially every single one of these companies right here, because my conviction has stayed the same and I'm seeing good deals in most of these businesses for the long term. These include high-risk, high-reward companies, low-risk, medium-reward companies, and also some very high-reward, potentially medium-risk businesses. And if you're really wondering from a technical standpoint where the market could be heading next, if we break this low right here, then chances are we might go retest this 327 level on the S&P 500. But chances are we might actually hold this area, because not only are we converging with this 200-day moving average, but we're also potentially forming a double bottom, which is historically a reversal signal. And as you can see, historically, the 200-day moving average has always acted as a good zone to buy the dip around, even when it tends to get breached in the short term. And as you can see, we have seen this pattern of rallying and then collapsing yet again to that previous low many times in the past, particularly during the election time of 2020, when we saw this initial collapse, a rally, and then another collapse right to that level before rallying higher after the midterm elections. And if you ask any investor out there, you'd know that buying during times of recession is often the best risk to reward you will ever find in the stock market. But obviously, guys, that is just my opinion, and feel free to let me know your thoughts down in the comment section below.